Welcome to Investors Insight, where today's topic is volatility the norm. We've got a lot to talk about today. Trey's going to talk about the Fed. Ty's going to talk about bonded stocks and their similar price actions. But first, I want to talk about volatility. We've had a lot of clients recently ask questions regarding what seems like never-ending volatility in the market. So I want to share a chart that shows that 14 of the past 15 calendar years, from 2008 to last year, the S&P 500 index endured no less than 2 negative total return months and as many as 8 negative months seen back in 2008. So from 2008 through February of this year, the S&P 500 index has endured a loss in 61 out of the 182 months since 2008. 2017, as you can see in the chart, was the only unique year that a negative month didn't occur. The important point I want to make is that even with the volatility seen since 2008, the S&P 500 has had an annualized total return of 8.95%. So in summary, as I've shown in the chart, volatility is the norm. Given that the recent news around the banking sector and stubbornly high inflation, we could easily see further volatility. That said, stock prices don't rise in a straight line, and investors are going to encounter turbulent times along the way. So something we'll continue to watch out for as volatility continues here. But Trey, last week, the Fed continued its path of raising rates. Give an update on that, and also from a historical standpoint on how it has impacted inflation.
Yeah, thanks, Bobby. So as we spoke about last week, all eyes were going to be on the Fed on Wednesday and what they were going to do. And the Fed raised interest rates by 25 basis points, which was widely considered, widely expected. A few weeks ago, a lot of participants expected a 50 basis point hike. But with the news out of the banking sector, many expected that maybe the Fed would pause. A lot of participants in the markets believe that if the Fed had paused, that would have been good for stocks, that would have been good for bonds, that would have been good for the banking sector. So why didn't the Fed pause? What are they looking at that the rest of the market isn't? And one of the things that was interesting is it appears the Fed is more focused on inflation and avoiding what is called stop and go monetary policy. And the reason they really want to avoid that is that was the policy of the 1970s when inflation was rampant for almost an entire decade. And you can see here on this chart that if you look at the blue line on this chart, which is the consumer price index today versus the red line of the consumer price index in the 1970s, you can see we're kind of tracking with the early 70s. And so what the Fed doesn't want to do is to take its foot off the brake of inflation and then allow inflation to go back up, and then we're just fighting the same battle a few years down the road. And so that's the risk of stop and go. It would definitely be positive in the short term, but it may be more negative in the long term. So that puts the Fed between a really good rock and a hard place of being too aggressive, maybe killing the economy and hurting the banking sector, or being too soft and allowing for a 1970 style multi-year, maybe even decade plus long inflation fight. And you can see on this second chart where the Fed funds rate of change currently sits. We are just now getting to the higher end area where that was needed back in the late 70s, early 80s to finally beat inflation. So a lot for the Fed to digest. In the short term, I think the markets may be wanting the Fed to pause, but in the long run, there's a lot of risk that may be what Chairman Powell's looking out is a little longer term.
Yeah, so I think we're getting closer to the end of the Fed raising rates and a rate hiking cycle here. But there's still some work to do. And so, as I said about volatility, as Trey's talking about, we're not quite done yet. So something we're watching carefully here. And then Ty, talk about bonds and stocks and the inverse pricing action. That's been a topic with clients recently. Talk about that.
Yeah, and this is a chart of the NASDAQ 100. So, 100 biggest tech stocks and the 10-year treasury yield. And it's how they're correlated. Something's directly correlated, it'll be at a 1. And so in this case, stocks and bonds would be moving in the same direction, whether that be up or down. -1 would be inversely correlated, which would mean if stocks are up, bonds are down, and vice versa. As you see in this chart, for much of 2022, stocks and bonds were pretty directly correlated. And while that's great when the market is moving up, last year, with the market being down, and there being no place to hide essentially in the bond market. So, people are saying, well, my stocks are down. How's my fixed income doing? Well, fixed income also, taking a hit. Things changed. The norm is that stocks and bonds will be inversely correlated. They'll work in opposite. And, SVP announced their capital raise. SVB Bank announced their capital raise on March 8th. And since then, we've seen stock prices go down, but we've seen bond yields go down, which results in bond prices going up. So stock prices down, bond prices up. That's something that is more normal in the market and something we like to see. And, go as far as some people go as far as say diversification is the only free lunch in this industry. And, it's important. Diversification is great. And when it's working properly. Last year, it did not work properly where, both things are down. So it's great to see us get back to this normal, and hopefully this is, sustaining longer term.
It's definitely a time to remain diversified, especially with the Fed causing some volatility here. Thanks for watching. If you have any questions about anything we've talked about today, please let us know. We'd love to talk to you. Have a great week. Thanks.